Morning, everybody. All right, I'm going to be introducing Paul here, but I want to thank all of you for actually being here this morning and congratulate all of you on actually getting a seat and commend you all for taking an interest in your economic health and future. So good for you guys for actually being here. We'd also like to thank the Greater Regional Alliance of Realtors for the use of this space. And this is the first time I've ever been in here, and I think it's a really nice space. And we want to thank our valued sponsors. Can you guys actually hear me okay? Yes. We want to thank our sponsors for making this event possible. One Last Eye Virtual Assistant, ATA National Title Group, Consumers Energy, Den Yule. Am I pronouncing that right? Denial. Thank you. Green Block Private Lending, Green Property Management, Inlanta Mortgage, the Stephanie Wood team, Lakeside Real Estate Services, Quest Property Management, United Bank Real Solutions, and United Properties of West Michigan. Thank you, sponsors, for supporting this event. And I am Brian Hamrick, the host of the RPOA's podcast, which is called the Rental Property Owner and Real Estate Investor Podcast. Comes out every Monday. Check it out. If you want to know how to check it out, come see me after the event here, and I'll show you how to access it on your phone. And I actually have the honor today of introducing our special guest and featured speaker. So in times of economic uncertainty, it's incredibly valuable to have someone who actually knows what they are talking about, share their data and interpretations of that data. And we are lucky here in West Michigan to have Dr. Paul Isely to mitigate the risks of investing in uncertain times and to bring clarity to what can seem like a very unclear economic outlook. So it's my honor to introduce Dr. Paul Isely, PhD, Associate Dean and Professor of Economics, Seidman College of Business and Grand Valley State University. Let's give Paul a big round of applause.
All right. So is my stuff on? Yes. Good. All right. I have a loud enough voice, and this is a small enough room. You might not need it. So, all right. So everybody's sort of interesting on where the world's headed, and hoping that I have greater insights. But we certainly have things to look at and ways to view this that you're not going to get watching the news. So anybody have a really busy year last year? Have a really good start to this year? Now you're sensing things are a little slower in some places, not in others. Okay. So West Michigan is really unique, and so we have to really look at that because what you're going to be hearing from some of those national components is going to be different than what you're going to be seeing here in the Grand Rapids area. So I want to make sure we walk through that. So for those of you who haven't seen me before, I want to make sure that you have some idea as to what my accuracy has been over time. This is my list for this year. So what we have here is the blue is the difference between the actual employment in West Michigan and what I said was going to happen. So I took what I said was going to be the growth in employment, and I subtracted out what actually happened. Okay? And you can see, therefore, that 0 means I'm exactly right at the end of the year. So this is my January prediction for the next January. You'll notice I was wrong this year, and that's 2020. So those of you who were there in February of 2020, we were talking about the fact that we were already in a light recession from manufacturing aspect. And I looked back on my notes, and what I said for you all was, if COVID is still in your news feed in 6 weeks, hang on, because it's going to be really bad. I had no idea what bad was going to be, but unfortunately, it's still in my news feed, and it's been far more than that. Okay? Just so you know, the orange and the black bars are the accuracy with which the U.S. government can count the number of employed people in West Michigan. So you can see I'm not only 0, but well within that range every year but 2020. So now the lawyers make me say, past performance is not indicative of future success. So I've said that, and so now the lawyers are happy. We do this at Grand Valley by turning economic modeling on its head. The traditional way someplace like U of M works is they go out and they run models with thousands and thousands and thousands of variables, okay? And they turn the crank and they come up with an answer. And then they'll run a focus group with a few local businesses and say what's going on. And then that's the forecast you get. And they're highly accurate, so I don't want to slam them. But we turn it on its head. We start by going out and asking all the businesses. And then we use that in the data. So it's not surprising to me that when I start by asking how many people are you going to employ this year, that, that businesses know better than data that's 6 months old. And so that's the difference between how I do things and how my team does things compared to what actually happens in a lot of this stuff. And then there's also what we call the lazy economist, all right? So the lazy economist is one that just sort of says it's going to be sort of like it was last month. Okay? So we actually have a measure called the lazy economist measure that looks at how wrong are they getting it, and are they getting it wrong in the same direction, because that will tell me when things are turning. So we have a lazy economist measure. I'm not a lazy economist. I'm always looking at the data. So this is where we're at. So 2022 is all about the pendulum swinging back. Okay? We overheated coming into this year. The pendulum got pulled way up, and it's going to swing back. Okay? If you know the old Spaceballs movie, he went straight to plaid. Okay? If you don't, you can go watch the movie. I think it still holds up if you enjoy Star Wars stuff. This is all the story that's happening this year. And then we have some overall trends. We're going to walk through that. We're going to walk through a couple of the shocks that are still happening. We still have COVID. We have the Ukraine. We have some overlying issues with millennials becoming older and the group behind them being a smaller group. And we have the Federal Reserve interacting, trying to slow down the speed with which this pendulum will swing back. All of that's creating a lot of uncertainty for people. So let's walk through what that looks like. Okay? So we got to start with COVID. Everybody's sick of hearing about COVID. Hopefully you're not sick with COVID. Unfortunately, you probably know somebody with COVID right now today. So we have a big surge going on right now, and it's annoying. But here's the good news. So those of you who have been following me for the last year and a half, this is the number I look at. I look at excess deaths. Because quite frankly, if nobody goes to the hospital and nobody dies, nobody cares if you got COVID. All right? So we're really looking for when that swings. All right? So to help you out here, way over here, on this side, those are bad flu years. So what we do is we predict the number of people who should die in any given week. We're pretty good at it. We know how bad Americans eat. We know how bad they drive. And we know how old they are. So it's pretty straightforward to calculate how many people we expect to die every single week in the United States. Okay? If more people die than that, it's called an excess death. Okay? So you can see during bad flu years, we have some weeks of excess deaths. Right? This over here on the right is COVID. Right? I'm not saying why these people died. What's nice about this measure is it doesn't matter why they died. We just know a lot more people died. So you would probably have had a friend, or maybe yourself, say, that person didn't die of COVID. That stuff is garbage, blah, blah, blah. This doesn't care about this. This just tells us more people are dying. Right? And that happens to coincide with surges in COVID in the United States. Right? It's possible we just had more car accidents that time. Highly unlikely. Okay? So when this goes to 0, like it was earlier this year, that's good news. That's when things end and we're done with all this. Notice that it came back up. That's the surge that we're in right now. By the way, although it's much harder to measure because we all test at home and don't tell anybody that we got COVID, we can statistically look for this. And what we do know is that the surge right now is very comparable to what we saw earlier this year. So our excess deaths now, compared to earlier this year, given that the prevalence of COVID is probably similar in both time periods, is really good news. This is continuing to show that we move in a direction of this being endemic and not being a pandemic that we have to worry about our lives with. Okay? That's important because until this stays down at 0 for a while, we still have supply chain problems. Anybody spend more money on lumber this year? Yeah. I think drywall just had a big bump. All of these things are happening because of that supply side problems. And those supply side problems are being affected a lot by COVID. So we want to see this get to 0. All right? COVID also made this entire slowdown that we're going into right now much different than anything that we've ever seen before. Okay? And the reason is very simple. The blue line here is people's disposable income. That's income after taxes. Okay? This is April of 2020. See this go up like this? Never before in history have we had 15% fewer jobs in a month and have disposable income shoot up. Right? Here in Michigan, we had 30% fewer jobs. We had the harshest shutdown in the entire United States. Okay? That's not a political commentary, it's just what it is. Right? Maybe we needed to do that. I'm not here to argue about that. I'm here to tell you what the effect was. The shutdown was the harshest shutdown, and we had a lot more unemployment. So if we had just been trending along as normal, we'd be down here on this red dotted line. But during the entire pandemic, first set of checks, extended unemployment benefits, second $900 check, March check, disposable income stayed above what we would have expected the entire time. At the same time, you couldn't spend any money, except on Amazon. And now they've discovered that, lo and behold, we were buying at Amazon not because we love Amazon, but because we couldn't leave our house. So now they've built too many distribution centers. So, but here you can see we spent not a lot. So if I'm earning more and I'm spending less, you don't need an economist to say you're saving. And if you look at the bottom 50%, they doubled their wealth between the start of the pandemic and the middle of this year. They doubled it. Okay? That's $2 trillion extra dollars for the bottom 50%. The next 40% increased their wealth by $8 trillion. That's a lot of extra money hanging around. So it's really created some weirdness now because things are slowing down, but on average, people have money. So it's confounding things because normally when things slow down, people have less money. They're just trying to make my life difficult. So here's that change in wealth we talked about. Here's the bottom 50%. This is their percentage change in wealth between the middle of this year and the start of the pandemic. And here is the next 50%. So you'll notice they're up by 20-odd percent. Okay? So this is not Bill Gates. It's not Jeff Bezos. It's not Elon Musk. They have more money too, right? But these groups are really well off compared to where they started the pandemic. Now they're spending it. Okay? Not only did their wealth go up, but their incomes changed. right? So the blue line here is your bottom 25% of income earners, right? Bottom 25%. Notice that their income is increasing year over year at about the same rate as inflation. They're not actually any worse off now, income-wise, than they were before it started. And it's actually better than that because they probably added hours and done some other stuff. Right? You'll also notice the next 25%, that orange, is also almost keeping up with inflation. It's those of us, probably all of us in this room, who probably are in the top 50%, where our incomes are not keeping up. All right? So think about what that means for types of houses, types of rentals, types of things. The people in the bottom are doing better and better right now relative to the people in the top half, right? So if you think about this, that bottom 50% during the 1990s held 4% of the wealth here in the United States. That dropped down to 0.3% in 2010. And then we had social unrest. Really? There's a reason why almost every major religion in the world has a tithe somewhere close to 10%, because you need to shift that much money to the poor in order to have a stable system. All right? And so that low of a wealth created instability. So did we see any instability in the United States between 2010 and 2020? So now, as a result of this and a result of that pandemic wealth, they have about 3.5% wealth, almost back to the 1990s. That's really good news, and it's probably something you don't hear in the news. All right? Now, there's one last thing here, because we blame them for everything else. We need to blame them for this. It's the millennials' fault. You laugh, but it's actually true. Who are the lowest income earners in a country? Who's in the bottom 20% here in the United States? The bottom 20% earn about $5,000 a year and spend about $25,000 a year. Mm-hmm. What type of person can do that? College students. And about 20% of the U.S. Young people are in college someplace. Right? They're on the bottom of that chain. Okay? We had a big bubble of them, right? So you'll notice they stopped being born around 1995, started being born around 1980, give or take a little bit. Okay? So at this time here, we now had 30-year-olds down to 15-year-olds coming into the system. And you'll notice, therefore, the bulk of that millennial group was in that low-income side. So if all of a sudden you have a lot more of something, what happens to the value of it? It goes down. And so the value of low wages went down. It was easy to find somebody to serve you food. It was easy to find somebody to do things because there were so many of them. That drove down their wages. Okay? Then about 2015-ish, now the youngest are 20, but the oldest are 40. They're moving out of those low-income jobs. At least we hope they are by that time. Maybe they're still in mom and dad's basement, but I think they were moving out by that point. And look at this. As they started to move out and we replaced them with Generation Z, which had far fewer, look at what happened. All of a sudden, the low-income earners were outpacing everybody else. And now what do we know? Now we know that even when I have to spend $100 on a meal for me, my wife, and son, I still have to use my own cell phone to scan a QR code and order my own food. There's not enough workers. Right? That's going to be a story too. So this is part of the reason. It's not the whole reason, but it's a very fundamental underlying reason why that was happening. All right? Now that they're moving into their 40s, what happens to their overall income capability? what happens to their ability to upgrade in housing? It goes up. And when will they start laddering to the next house? In about 10 years. Good news. All right? So, that's the first part. Let's do the Ukraine. Anybody heard about the Ukraine? It's really annoying and quite tragic. But from an economic point of view, it's created some interesting things. Right? There's two primary drivers that we've seen here in the United States, of course, and that is fuel and food. And unfortunately, we spend about a third of our income on food and fuel. All right? So this is the one you haven't thought about much yet. And you haven't thought about it much yet because we got lucky this summer in the United States. We got really, really lucky. And we don't even know it yet. We got lucky because there was an explosion in a natural gas plant in Texas. And as a result, we haven't seen the increase in natural gas prices yet. Wait, whoa, why does that? Okay, look here at the end. We get up to a price of $6 per million BTU. Okay? In Europe, it hit 60 on one day. 10 times that. If you own natural gas, do you want to sell it here or in Europe? Unfortunately, to do that, you have to liquefy it and put it on a ship and send it over. The Freeport plant, which exported 20% of our LNG, had a fire, and it's not back online yet. So we couldn't ship it there. So what did it do? It stayed here and kept our prices lower. They go to 50% capacity next month and 100% capacity probably around November. What's going to start happening? You throw in a cold winter, and this will be 14, 15 bucks pretty fast. Okay? So think about what you're paying now. It's going to go up. And it's going to stay up for a longer period of time. Because I don't see Russia selling natural gas to Germany anytime soon. By the way, this is what we expected before the Ukraine. So you'll see that it even added a couple bucks for us here, despite what we saw with Freeport. You paid more for gas this summer? You're getting happier now it's going down, right? A little bit. Right. So what happened was it became really hard for Russia to sell oil. It became really hard for them to do it. We started adding rigs, but nowhere near as fast as we did the last time prices went up. It's harder to do it. The regulations are harder. It's harder to get money. And the investors have figured out higher prices are better than more oil. All right? So you add all that together, and they didn't add rig as fast as they did before. But we are. We're increasing our supply of oil slowly. At the same time, when prices went up, all of you changed your consumption habits. So if we go here to Grand Rapids, you can see we're cruising along. Orange is this year, blue is last year. We're cruising along, consuming more gasoline than we did the year before. Prices hit $4 a gallon. Uh-oh. Slowed down. $5 a gallon. Slowed down. Prices have dropped now to, what, $3.60-ish? Uh-oh. We're consuming more. So, if we're increasing our consumption because the price went down and we're now consuming more than we're producing, you expect the price to fall a lot more. Probably not. All right? So what we do know is that it came down. We do know that it's probably about as far as it's going to go. You're going to get a little bit more because the price of oil is going to drift a little lower. But you shouldn't expect to see it accelerate much further down. So what has the Ukraine done for us? It's increased your price of gasoline compared to before the start of it and now by about 40 cents once it's all sort of washed out. But you got to spend a summer spending a lot more than that. Okay? When people say, okay? The second place is food. So this is Ag Input Price Index. Ukraine affected us in many ways. First of all, they do a lot of wheat, and they're just starting to get some of that out in any sizable measure. How much? About 15% of the tradable wheat in the world. Okay? 15% of the tradable wheat. And they all stopped. That caused wheat to spike, and now that it's coming out, it's drifted down, but at a higher level than it was before. But they also make fertilizer components. They have some of the natural resources for that, and a lot of fertilizer is made from natural gas, which we know is going up in price now. All right? So fertilizer is more expensive. Oil's more expensive. Labor's more expensive. It's more expensive to make food. And that's not going to change. That's here to stay, even though we've come off the highs. Remember, the world's a pendulum. Oh, we overshoot. It'll come back, and then it will dial in. So we overshot on both food and fuel this summer, and now we're coming back to a higher equilibrium than we started before. Okay? There's also things in the Ukraine that are odd that you might not even have thought about yet. So does anybody follow noble gases? No, probably not. Right? These are gases that can't react to others because they don't have a spare electron. I also have a physics degree. Okay. But you need them to make things like lasers. Why do we care about making lasers? Because you need lasers to etch computer chips. Now, early in the war, do you remember the Ukrainians held up in this steel plant? Yeah? And basically, that steel plant doesn't exist anymore, right? According to Bloomberg, about 50% of the noble gases created in the world were made at that plant. And we had a 6-month supply at that moment in time. What's going to happen to the price of noble gases? What's going to happen to the ability to create computer chips? What's going to happen to anything else dependent on those processes? So what the Ukraine does is it stirs in some uncertainty. And when there's uncertainty, what do? Well, the average human hunkers down and doesn't spend money. The average business hunkers down and doesn't spend money. And what does that do? It slows down the economy. The Ukraine, if we have about 8% inflation going, depending on how we measure it, about a quarter of that is because of the Ukraine. About a quarter of it is because of COVID, and about half of it is because we gave people about $5 trillion to fill a $2 trillion hole. Right? The good news for inflation is COVID's starting to go away. The Ukraine has stabilized, and people are spending that extra money. And eventually they won't have more. Okay? So from an inflation standpoint, a lot of this will start slowing down. Okay? We've almost got the big picture so we can get back down into real estate. So, but what we're telling you right now is you're going to be spending more on food, and you're going to continue spending more on food at least through next summer. You're going to be spending more on gasoline and diesel, but that will be better than what you had this summer, just worse than what you had last summer. Okay? Your natural gas bill is going to go up this winter. And it's going to be harder for farmers to produce food at a rate that makes sense. Okay? So prices, drivers of inflation. So I have 3 lines here. I got to have lots of squiggly lines, otherwise you don't know I'm an economist. But let's have a squiggly line. The orange is the consumer price index. So that's our measure of inflation that all of you are spending. Okay? The black line is producer price index. So that's the price that businesses are paying in order to do things, to purchase things. And the blue line is compensation. So you can see since about 2014-15, compensation has been outpacing the CPI. Also something you don't hear in the news. Why? We already told you why. The millennials grew up and they got better jobs. There weren't enough Generation Z people behind them, and so the wages on those jobs went up. All right? And you all have to pay that every time you get grass cut now, because you don't need a huge skill set to cut grass. I earned my first $1,000 in 1982 cutting grass. So notice I said cut grass and I didn't say landscaping. Big difference between the skill sets. All right? All right. So notice that happened. Then notice this over here. That's that pop in prices that they have to pay because of COVID and the Ukraine. Notice how far it went above this. That's going to pull this up and keep it going up for the next 6 to 12 months, no matter what the Federal Reserve does. It'll be going up slower than you saw at the beginning of this summer, but it's still going to be going up, right? And here you can see that starting to turn now. So the blue line is a short-run trend. The orange line is a long-run trend. If blue is above orange, we're speeding up. If blue is below orange, we're slowing down. This is core inflation. It strips out food and fuel. Everybody's like, why do economists do that? We do it because food and fuel jump around an awful lot. It's also the type of inflation the Federal Reserve can't affect. So we want to actually see that core. How is those other things bleeding into everything else we buy? Right? But here you can see we've been speeding up, but now that short-term trend is starting to accelerate slower. And sometime here in the next few months, we would expect that they're going to cross again, and we're going to start seeing that inflation rate slow down. Okay? So you all care about inflation. You're all trying to figure out where it's going, and you're hearing lots of different answers on this, right? We projected at the beginning of the year what inflation would be. We haven't changed our answer on what inflation will be at the end of the year. What we've changed is the number of interest rate increases, because the Federal Reserve can affect the prices by changing their interest rates. All right? And they're going to have to do more interest rate increases than we thought at the beginning of the year in order to keep that price level what we expect at the end of the year. Okay? It'll still be faster than any millennial's seen other than this summer. You got to be losing hair or have hair gray like mine to remember the last time we had inflation like this. So, and at the time I had a 14% CD. So consumers are really pessimistic right now. Look at this. The last time they were this pessimistic was 2007, 8, 9. Oh my gosh. Do your businesses feel like 7, 8, 9? Probably not. All right? Probably not. They're really pessimistic. Do you know what? This is why economists don't believe what people say. Because they're this pessimistic. They're slowing down how fast they're spending, but they're still spending more, even adjusted for inflation, than they were last year. This does not sound like pessimistic people to me. They're buying stuff. Buying less stuff than they want to because we have to adjust it by inflation. If we didn't, they'd be buying a lot more if we didn't adjust it for inflation. Adjust it to inflation just a little bit more. All right? but they're still buying more stuff. I don't believe they're pessimistic. I believe that they're confused. They're confused because people are telling them things are slowing down. They see that somebody going for a job, still getting a job, but maybe not the job they wanted. They're seeing that they're getting a bigger raise packet, maybe not as high as inflation, but they're seeing it. And they're still seeing McDonald's paying $20 an hour. So they're like, you know, if I lose my job, I can always go to McDonald's. Don't. Okay? They're confused about what's happening. They're confused because we have lazy economists who are telling them, we expect unemployment to go up, we expect all of these things as the economy slows down. Because that's what always happens when the economy slows down. But we've never been in a situation where we have way too few workers for what we're trying to do. So even as we slow down, people will be able to get jobs. Maybe not the job they wanted. Okay? Whoa. So going forward, interest rates. Anybody worry about interest rates? Okay. So this is what's been happening. I've smoothed it out to monthly so you can actually see it. Otherwise, things jump all over the place. Okay? And where we were at just last month is the market had already built in 150 basis points, 1.5 percentage points of more increases by the Federal Reserve in mortgage rates, which is why you've actually seen them come off of their peak here in the last month, because they overshot, worrying about where it was going to go. Okay? I cannot predict the Federal Reserve. Right? We know they're going to increase interest rates more. We know that that's going to increase this orange line because that's the one that they affect. They don't affect this one. They just make it more expensive for banks to borrow, so the banks then increase the amount, the expense for you to borrow. Okay? Anybody notice that your savings interest rates haven't gone up? You know why? We have $10 trillion in extra wealth, and a lot of that's in our savings account. The banks don't have to give it to us because we've already put it there. As that starts to bleed off, they'll have to start increasing their interest rates. It will make my dad very happy. Because if you think I have gray hair, you should see his. All right? So, what do we know? We know we're going to see more. This will continue to go up. You can see that in normal times that there's about a 2.5 to 3 line difference between the two. We're back to about that gap here, a little bit more than that. So every increase you see by the Federal Reserve will not result in the same increase in mortgage rates at this point, because we've already overshot it. The bond market's already betting on the fact that the Fed will have to cut back in the middle of next year. We'll tell you what to do to watch for that, okay? Because all we can do is watch. But we can tell you that's going to go up, and we can tell you that we expect this number here to get to about 3%. You go 1, 2, 2.5. That would suggest that 6% is probably where we will see those interest rates top out. Probably. Right? But it will depend a little bit on how much we decide to buy stuff to speed up inflation. Okay? So, those interest rates went up. We already nationwide saw a slowdown in housing. So months of supply went back above 2.5 months nationwide. And I actually didn't put on the last month here. actually close to 3. Okay. So nationwide, we saw that. A little different here in West Michigan, which we'll get to in a second, but that's what we saw nationwide. We also saw a drop-off in light vehicle sales, something else you buy with interest rates. And we know that it's real because the inventory of cars on lots is actually going up, not down. So we can tell you that the two things that are most dependent on interest rates are already slowing down nationwide. And here's one for you in Michigan. This is called a warn notice. So if you're going to do a layoff and you're a big company, you have to provide a warn notice to the Labor Department. Okay? Notice that it's not 2020, but we have seen from the first half of 22 an increase in warn notices, and we have had 3 times the layoffs so far this year that we compared to last year. We're selling fewer cars, fewer houses nationwide. We're laying people off. It's not showing up in unemployment because you can get another job. So what about Michigan then? This is United States, but I want you to see this because it's really, really important. Okay? This is months of supply of new houses. New houses. Look at this. Look at this. By the way, go back in time. Anybody remember 72, 74, 81, 82, 91, 2007? We've never seen this raise, this speed of a raise of months of supply of new houses without also seeing a recession, at least since 1970. All right? This is a big deal. What this means right now is the data hasn't even picked it up yet because it's happening so fast, is we've already seen new house builders slow down. We've seen some cut off projects. We've seen some projects delayed. They never say we're not going to do it. We're going to delay the project. All right? Maybe we'll do it next year. We've seen all of that start to happen, and it's only been in the last 45 days. So this data that I get to collect from secondary sources hasn't caught up with my phone calls to new home builders, which is already showing a substantial slowdown in Michigan. All right? And remember, here in Michigan, we're better off than the rest of the country. Why? Because we haven't overbuilt. I've given this one to you an RPOA before, but we'll do this one again because it's so important. Remember, fundamentally, you have to have people to buy houses or to get into rentals. If you don't have people, you aren't going to have anybody looking for someplace to stay. So the orange line is the change or the number of families compared to the increase in families since 2010 in the Grand Rapids MSA, which means Kent, Ottawa, Barrie, Montcalm counties. Okay? I don't know why I say Barrie and Montcalm counties. Once I've said Kent and Ottawa, you have 97% of the population. But nonetheless, we see this. Look at this. The total number of new houses have gone up at basically the same rate. The problem is this. Notice this is new single-family units. So about 2019, everybody decided that they wanted to be in a single-family unit because they didn't want to get COVID walking down the hallway of their walk-up apartment. And they couldn't get into them because we haven't been building single-family fast enough. for what people's tastes are today. But multifamily has been keeping up, has made up the difference. All right? So that's what we see happening. We haven't overbuilt. And this number is wrong. Particularly for Kent and Ottawa County, we have undercounted the population. Okay? Why have we undercounted the population? Well, we always undercount, particularly minorities. Okay? So if you go back 1960, 1970, 1980, 1990, 2000, 2010, we undercount African Americans by about 1.5 percentage points with reliability, and we did again in 2020. Okay? What changed between 2010 and 2020 was the amount that with which we undercounted Hispanics. All right? We also were consistent on undercounting Hispanics, and all of a sudden that undercount tripled in 2020. There may have been some concerns about immigration in 2020 that caused people not to answer. Okay? Ottawa and Kent County have a very high proportion of Hispanics. And it probably undercounts our population in those two counties by about 20,000. Okay? So it's not an insubstantial amount given what we have here. So this has been undercounted a little bit, but what's really happened is we have a mismatch between where people want to be and what they have available. But we still don't have quite enough. Oh, we'll do housing first. So if we compare us to Detroit, you can see that over the last 10 years, we have substantially outperformed Detroit. And Grand Rapids has substantially picked up here in the last few years compared to the east side of the state. Okay? And if you compare Kent County to the counties, to the more rural counties around us, I'm sure Muskegon would be offended by that, but they are more rural than Kent County. All right? You can see that their increases are much slower than our increases. So remember, this is an index, so it says, given what the price of the house was in the year 2000, how much more would you need now? So for every 100,000 you needed in the year 2000, you need 180,000 now in Kent County. Okay? So this has resulted in some of what we started to see, because if we go back to 2021, this was the average monthly mortgage rates or mortgages that were being issued in those counties. Okay? So you can see that Kent is $300 to $400 more per month. Okay? If you adjust the 2021 to the current interest rate and the current average house price, which is another 15% higher than it was then, all right, you will get another $400 to $600 more. So this has increased more than 50% between last year and this year. So we have seen a slowdown. We have seen people shifting the types of houses they're looking at, the types of finishes that they want in their house. We still have enough people because we still have more millennials in Kent County than we have old people. Not true in Ottawa, not true in Muskegon, not true in Newaygo, but it is true in Kent County. And because of that, we know that they are going to continue to want houses. They're going to continue to find a way to purchase houses, even with 6% interest rate. Okay? But it's going to be harder and harder to push through price increases. Right? But we also know that if there's a 9-month supply of new houses nationwide, what's going to happen to the production of new houses? It's going to go down. We're already seeing it, as I said, here in West Michigan. It's happening faster in other parts of the country. So what happens to the amount of drywall being purchased? It's down. So it will take 3 to 6 months for us to start to see those price effects on some of the building materials. But we would expect that in the spring, it'll be easier to find subcontractors, and it will be easier to purchase materials without having to wait forever for them. And likely, you might even see better prices. Okay? So we're starting to see that happen right now. As I said, I think we had a 30% increase in the price of drywall just this last week. But I expect that we'll start to see that ease as we get into next year. Okay? And rental rates, here you can see that Grand Rapids has now caught up with Detroit, which tells us that we probably are not producing quite fast enough for rental units, or more likely, those millennials are getting stuck in rentals for longer. They're at higher income levels, so they're looking for higher level rentals. So what we're starting to see is because they can't get into a house, they're laddering up in their rentals as opposed to laddering up into a house. Okay? They're like, for gosh sakes, I'm 35. I'm not sitting in an 800 square foot semi-studio apartment. All right? In a 150-year-old house. Okay. So changes since the beginning of the year. So compared to January, I actually talked to your group in February, but I hadn't changed anything by that point. We talked about employment growth in West Michigan would be around 3%. We can currently say that that's still going to happen. Right now, we are right on track for 3% this year. Okay? Sales growth, we said, would be about 2.5%. We currently say it's going to continue in that 2.5% rate. Okay? We do think the employment growth may scooch towards the bottom end of this range, and it's going to scooch to the bottom end of that range because we're out of workers. So they want to hire more. There's just nobody to hire. Okay? Wage growth, we were talking about the 5% range. We currently believe it will stay in the 5% range. Okay? Inflation, we were talking about the 6.5% range at the end of the year. We still believe it will be in the 6.5% range at the end of the year. Okay? Remember, in 2021, I told you at the beginning of the year that inflation at the end of the year for CPI would be around 7%. The average economist that year was calling for 2.5%. All right? We still believe that this year, as we reach the end of the year, even with the increases in interest rate we're expecting, that we will still have core CPI going at this rate, and it will because the Federal Reserve can't change those pieces. Okay? They've been very effective to date because most of this has been demand. It's been demand from people having too much money from the stimulus money. Like, wait a minute, you just made a political comment. You must be a Republican. No. Supply and demand. Supply and demand, people. So think about this. If prices are going up and people are buying more, it has to be an increase in demand. It has to be that the increase in demand is bigger than the increase in supply. Okay? Or the decrease in supply. All right? So don't worry, the decrease in supply is also affecting prices. Both the Republicans and the Democrats are right. All right? Or they're both wrong, whichever way you want to say it. All right? So interest rates at the beginning of the year, we were expecting about 75 to 125 basis points. The Ukraine added about 100 to that in order to slow down the economy. All right? We're now looking at 250 to 300 basis points for the year. We're up 225 already, although not ineffective in target. Okay? So that's what we're expecting right now. That would place us at the end of the year somewhere close to 6% on the mortgage rate. We said things would noticeably slow down in the second half of the year, and we said, yeah, it's still going to, and be faster than what we thought. So what should you be looking for? What we know is you need to be looking for some stuff. You need to be thinking about stuff because things are weird enough, I might not be right. All right? So you need to know when I'm wrong so that you say, okay, he said this was going to happen, but now I need to change what I'm doing because something's changed. Okay? So I'm going to talk about 4 things you should be watching. Okay? First one is consumer spending. Right now, we expect that consumer spending will start to dip here after we get past back to school so that you start seeing that go negative, okay, in real terms. If you don't see consumer spending go negative in real terms, then we're wrong. And things will be hotter than what we said, and there will be more interest rate increases than what we said. Okay? So be watching for that. Normally, I don't pay attention to consumers. The consumers are the last to know something's happening. Think about it. Who's the last person in the office to know they're getting fired? The person getting fired. Okay? Consumers are the last to know the economy is slowing down. But right now, what's keeping us chugging along is all this extra stimulus money that they have. If that wasn't there, we'd already be in what feels like a recession. Okay? The Federal Reserve, they get the trade-off between interest rates and price. Right now, they're threatening big increases in interest rates to try and scare people out of price increases. The problem is that when price increases become expected, they get hard to get rid of. Okay? And you know they become expected if you hear somebody use the phrase, I better buy that now because it's going to be more expensive next month. Okay? Anybody hear anybody say that? Yeah. Okay. In the late 1970s, early 1980s, car salesmen used that as a sales tactic. You better buy this baby now because next month it's going to be more expensive. All right? So if you believe prices are going up, you accelerate your consumption. If you accelerate your consumption, what happens to prices? They go up, and it becomes a self-fulfilling prophecy. So the Federal Reserve is worried that you've all convinced yourselves that there's going to be more inflation than there is. And therefore, they believe that they have to increase interest rates and make you a little bit more miserable in order to wring that out of you. Okay? We're hopeful that they can do that without doing what Paul Volcker did in 1982, 84. All right, when I had my 14% CD. We don't want that. But if you think about it, the percentage increase that they're doing right now is very similar to what happened in the early 1980s. Okay? Meaning, in the early 1980s, we started at about 5% and went to 11, 12, 13%. Here we started at 0, and now we're getting up to 6%. Okay? So right now, if they do more than what I said, things will slow down faster than what I said. If they do less than what I said, then you'll have more inflation than what I said. Okay? Supply disruption. All right. Right now, we're counting on the fact that China is getting sick of zero COVID and is starting to create social unrest when they lock things down. Did anybody see the movie of the IKEA? Yeah? Did anybody? They detected somebody with COVID in an IKEA, and there was a herd rush to try and get out of the IKEA before they locked it down, and people were going to be stuck in the IKEA for the next 2 days. That sort of panic is leading China to choose a shallower and shallower path, which is making less and less problems on the supply chain. Okay? But if they decide not to, and they decide to start shutting things down again, that will be a big issue. If Russia decides to completely shut off natural gas, I don't think they will. They're making a lot of money at it. Then there'll be more supply constraints, there'll be higher price pressure, and more interest rates than what I said. Okay? And deflation expectations, be listening to people. Be listening to people when they talk about inflation. If they think inflation is really going to keep cooking along at a really, really high rate, then you need to be prepared for more interest rate increases, more wage increases, and we're going to be fighting an inflation spiral as we get to the end of next I don't think we're there yet. But if we are, be watching for it. Because if that's there, you're going to see more interest rate increases than what I said. And the biggest effect on that will be housing. Okay? So we've gone through what I think is going to happen, which is reasonable growth in West Michigan, probably housing prices, at least for Kent County, continuing to go up, but at a slower rate. In weaker areas, we may start to see some retrograde on prices as we get into 2020. So again, it's going to be about the position of where you're buying, and you're going to be looking for lots of young people. Wherever there's young people, you're going to be okay, right? That the Ukraine has mostly stabilized, and so the effects of it you don't have to worry as much about anymore. COVID is stabilizing, you don't have to worry about it as much. There's my 1 hour of Paul. So I think that we have 20 minutes of you asking me what you think is most important.
We are recording this, so any questions? I'd love to get them on microphone. Is this working?
See, I've stunned them.
I'll start you out with a question, Paul. Given the inflation and the rent increases, at what point does that catch up to people's ability to pay higher rents?
Right. Well, what's really interesting about that is we've just crossed average rent and average income in Kent County. So if you think about that, you shouldn't spend more than 30-ish% on your housing. We've just crossed that here in Kent County. So we can't handle lots more increases. And so we would expect that that has to slow down, or you have to expect that they're going to want to have three college students in your apartment as opposed to two. So somehow they're going to have to make up that differential. So here in Kent County, it's problematic. Ottawa County, particularly in places like Georgetown Township, still pretty hot. As you get into that more rural area, it's still pretty affordable. Muskegon's still pretty affordable. I'm still surprised I don't see more people choosing to commute from Muskegon. We see more of it now, and we've heard realtors say that more people are choosing to do that, particularly with hybrid work. Only have to drive 2 or 3 times a week, and it's only 40 minutes. Pretty nice. There's only a few deer you have to dodge. So I'm really surprised I don't see more of that. But evidently, young people do not want to commute at all costs. So they're willing to spend a $500 differential every month to be close to their office as opposed to 40 minutes from it. So be watching for that change of taste. If that price goes up far enough and it's starting to get there in Kent County, it will force people to decide to take that drive. And there's cheap alternatives relatively close.
Bring you the microphone here.
I'm going to tie my shoe quick here so that I don't. I broke my leg in December. I don't want to do it again.
Morning, sir. Just wondering where you see spot prices for gold and silver.
For gold and silver. Oh, man. Gold and silver will continue to move with international uncertainty. So I'm not going to give an exact price. But I will say right now that there are a lot of millennials who just got burnt on cyber in pretty bad ways. In fact, when I was doing labor negotiations and I was talking to some of the millennials that were in the labor negotiations, they're like, yeah, I'm 100% in crypto. Okay, well, I might have done that when I was 22, but I'm old, so I didn't buy it when I should have. So, you know, there's some movement to more traditional hedges. So there's going to be firm support on those in the near term. There'll be firm support on it. So they will be worth more than they would have been without Ukraine and without some of the recession pressures we see going on. But I don't know what the number will be. So.
Dr. Isely, you see restaurants shortening their hours. Some of them are closed completely for days, and it's staffing shortages, and it's happening to other businesses. What do you see having to happen in order to bring that back to a equilibrium point, if you will? Is it substantial business slowdown? Is it technology changes? I mean, you mentioned QR codes and ordering yourself, but what do you see happening that would all of a sudden bring that back into equilibrium?
Well, the word all of a sudden isn't going to happen. So we've been talking that the 2020s would be the decade of labor for almost a decade now. So because the demographics were just awful. We have fewer and fewer young people. And it's even worse here in Michigan because Michigan essentially had a recession from 2000 to 2011, where the rest of the country only had a short one in 2001 and then another one in 2007-8. Okay. So Generation X left Michigan and had their babies in Houston and Georgia and Colorado. They may be back. So we're starting to see some move back, which is nice. We have net migration into the area, which is nice, but it's not fast enough to maintain the job growth that we need to fill what you're talking about. All right. In fact, that lack of jobs means I would expect that I start to see more activity on seasonal immigration and things like that. But right now I'm not seeing it. As I look at we can actually look up. It's public stuff. Who's bringing people in? So last year, the biggest seasonal help in West Michigan, I don't know if they're here today, I believe was DJs. So, which they had almost nobody compared to what you would see in a place that uses more of it. Almost all the farm workers go through Hoopersville. Well, someplace, small little podunk up north of here. There must be one law office that does it all. So we need some more immigration into the area. We will start to see some relief around 2030 because the millennials won't be retiring yet, and their babies will now be making to a point where that they're coming into the workforce. So the millennial echo starts in about 2028, 29, 30 here in West Michigan. So we start to see some pickup in that bottom end of the market in that time frame. I pay very close attention to this. I'm a college professor, and our target audience is that group of people. So we know that. So technology is the other side. So we saw the Grand Haven restaurant play around with using a robot for a busboy. Did you see that? No. So I don't know if they're still doing it or not, but they are. They are? Okay. And I'm like, how the heck does that make sense? And then they said what the price was. So I took the price. I put on a maintenance cost per year. And then I compared that to a busboy at $9 an hour versus a busboy at $15 an hour. At $9 an hour, it's more than a 5-year ROI. No restaurant in their right mind does a 5-year ROI. All right? Gordon Ramsay would come and beat them up if they did. Okay? At $15 an hour, it's a 1.5-year ROI. So what's happened is that bottom side. So if we look at that semi-skilled wage, so I have data from a very local employment agency, and they can show you that the bottom end went from $11.18 to $12.19 to $13.20, $14.21 to $15 to $16 in 2022. This isn't COVID. This is the demographics moving away from us. It started well before COVID was there. So that bottom end price is up. If the price raises high enough, substituting to technology starts to make sense. But it's going to be fewer restaurants are going to make it. They're going to have thinner profit margins, if that's even possible for a restaurant. Um, and, um, and everybody's going to be scrounging for that labor for the next 5 to 10 years because that technology is not changing fast enough. And even where it is changing fast enough, your ability to install and train it isn't fast enough to keep up with what your needs are. So I expect we'll continue to see a bit of a slowdown. We'll see fewer choices. But I can tell you, I'm putting in a new kitchen. I'm not running into lots of delays at this point. I can tell you that as a result, I go to stores like to buy furniture. I walked into one furniture store and there were, I had 7 different salespeople accost me to purchase stuff. It didn't seem like they had a labor shortage. I'm starting to, as I go into restaurants, not have the same wait as I used to. So those that are being successful are still able to get workers. I can tell you that it costs a lot more. So compared to 2 years ago for me and my wife, it's double what it was then in a county. So I think it's going to cost more. There's going to be fewer choices, but I don't think there's an easy fix because there's not enough people. I'm an economist. I can filibuster.
Okay, so I'm just wondering about the crypto because I know some people say it's fake, like you should not put money into it, and some people just put a lot of money into it, and then now I think it's like a crypto winter right now. So what's your suggestion for crypto?
What's my suggestion for crypto? My suggestion for crypto is, number one, don't consider it a medium of exchange yet because it's not treated as a medium of exchange. It's treated as an investment good, okay? And understand that it's not going away, but it hasn't found its equilibrium. It doesn't know what its equilibrium is. So it's going to be very volatile. Volatility means don't do it on margin unless you got lots of money. And you have to be prepared for big ups and big downs because it's not going to be any other way. So if this is your investment strategy, it's probably not diversified enough. But it's going to be a part of anybody's portfolio going forward. And I wish I had bought it at 50 cents. So.
Dr. Isely, seems like a lot of the real estate classes have gone up in price pretty significantly over the last 3 to 5 years.
Yep.
Is there any asset class in real estate, since this is a real estate room, that might fare better than others from a value perspective in the next 1 to 2 years?
Yeah. Ooh. You know, that's a little hard because it's also very localized. Because it's going to really depend on your mix of things within that very local region. So it's why I always talk to realtors because they know far more than I do about a 5 square mile area than I would, and I don't have the time to do that. There's some things that we know. Here in West Michigan, we are underproduced in single family. So single family is going to have much more support than multifamily on the residential side, okay? That doesn't mean that multifamily is not a good investment. It just means that on a capital gains perspective, it likely isn't going to see the same. On the commercial side, interestingly enough, we've seen West Michigan play wait and see. So what we're seeing is that Class A is still filling, still doing fine, but they've really shortened down the amount of lease they're willing to do, okay, as they try and wait out and figure out how willing their workers are to come back to work and how much they're going to need their workers to be back. So they haven't quite figured that out. I think that there are some corridors where there's still some room on retail. Because what we're seeing now is sort of that backlash against Amazon happening, at least in the short run. I don't know how long that will be, and I would never bet on Bed Bath & Beyond actually making it. So there might be a big box someplace near here. You know, what we're seeing is smaller footprint. We're seeing cross with storage for pickup. We're seeing different commute corridors than we saw before. So you need to look at your local area and say, how have the commute corridors changed? What's different about them? Is there more people coming along this direction now because of things happening in this area? So I think that there's some good choices there if you look very locally. I think Class A has been doing fine. Industrial, we don't have it. We don't have what we need. It's all greenfield, and it's actually a constraint on our economic development at this point. So I'm not sure I've fully answered your question. There's lots of Class B running around out there. And I think that Grand Rapids probably overdid multi-use mixed development because there's only so many stores willing to be on the first floor of an apartment complex. And I can say that's true because I drive through downtown and there's a lot of them empty. Not only empty, but never been filled. So I think your Class A is fine. I think your single family is going to have some opportunities, particularly if those costs come off a little bit here in the spring. And I think those costs will come off a little bit in the spring for manufacturing. Did I answer your question? Or did I avoid it skillfully like a good economist?
So Tesla splits again in 2-3 days, and what's your predictions? Buy or don't buy?
Oh, for Tesla? Oh, man. I've been burnt by Tesla more than anything else. Because Tesla has more to do with tweets than it does with manufacturing capability. You know, so what we do know is that their competition is getting better. We do know that their costs are going up because we have limited access to some of the materials that are needed. And we have a CEO that is not focused on one business. So to the extent that the Robinhood investors are willing to support it, you should be there and take advantage of it. But there is an awful lot of future growth built into the Tesla price that they will be lucky to achieve. So if you're using it for the long haul, I'm still skittish on it. So short run, it depends on what your investment focus is. So, I would get worried about holding it for long though. So eventually the SEC will catch up with him, and he'll have to dump some shares. The good news is he's done dumping shares right now. So he's dumped enough shares to buy Twitter. So that's withheld the price now for about 6 months because he's been unloading lots and lots of shares, and so this next 6 months might be an opportunity because it won't have that drag on it that it's had for the last 6 months. So I've sort of given you food for thought, but I haven't answered your question directly.
Going back a little bit to the real estate investors in the room, you responded some to the single and multi and commercial uses. Can you tell yet, or do you have a estimated prediction for more the short-term type rentals or the campground type sector?
Ooh, that's
either in Michigan or even nationally?
Okay. Interestingly enough, if so if we do short-term rentals, I think certainly they've done well here in West Michigan. Grand Rapids, however, has changed their hotel count per number of people. So we went from being way undercapitalized in hotel space being capitalized halfway between a normal Midwest town and one that has tourist attractions. So if you believe that we have tourist attractions, we may be about right. If you believe that we don't, then we have too many. That will put downward pressure on short-term stuff. There's some regulatory pressures happening on short-term stuff as well, which may throw some wrenches in. But I don't see any big downside there. So you said short-term and which pieces?
Like your campgrounds, people that are just going to travel,
Yeah.
vacation.
Well, my bet is that it's much cheaper to get into an RV now than it was 2 years ago. Because there's, we'll see. Says no.
I bought a mini trailer 2 years ago
Uh-huh.
at 11,000, and my agent appraised it. Insurance agent appraised it for 19. So
Okay. Well, we'll see what happens there.
yeah.
There's a whole new class of people who have discovered camping in the last few years. And many of them have discovered that they don't like camping, but many of them have discovered that they do like camping. So there will be a higher number of people willing to do that and looking for quality spaces. There are a lot more RVs out there, whether they're used or new. And so they're going to be looking for the correct hookups. So I think that those are opportunities right now. I have not studied that market completely, so I do not know the market saturation right now. If you want me to look at that, you'll have to send me an email, and I'll think about that. I can say that along the lake shore, short-term rentals is going to stay good for the foreseeable future.
Some more destination type.
Yeah, if you have a reason for someone to be there, you're going to do just fine. So, on average, I can't be that definitive, or the lawyers get angry with me.
Question here, can you go in any more detail on mortgage rates and how they set that? And the banks are already expecting the increases to come. So how far do they set that ahead in their pricing? Before they even announce a new rate hike,
Right.
you're already going to be locked in at a certain, they're already expecting some of that to come out.
What they have to do is try and understand what the interest rate is going to be over the next 10 years. They're giving you a 30-year loan. They expect that you may buy out of it at some point, but they want to know for the next 10 years, what do things look like? So what they're trying to feel out is how much of this is a permitted increase versus not. Okay? And so we're going to be in a higher interest rate environment. They know that, so they need to build that into their interest rate. They also have to build into the fact that the next 2 years, they expect interest rates to be higher. So they have to get ahead of it, and there's less competition now. So there are a lot of non-banks banks that were mainly doing mortgages, and a lot of those layoffs that you're seeing me talk about are coming out of the mortgage industry. Not because of new mortgages, but because nobody is refining right now, because if you're refining right now, you've missed a lot of opportunity that was much better than now. And so maybe you should listen more when you're eating out. But so that's what they're looking at. They're looking at what's happening to that long run over the future. And then they have to be at market. So that's going to be affected by the demand of people looking for it, as well as their costs that they expect. So right now, we haven't seen a slackening in people wanting to get in mortgages here in West Michigan. What we've seen is a slackening in their ability to pay. And so we would expect those interest rates will go up. So as I talked about here, I expect about another 100 basis points over the course of the next, next 6 to 12 months by the Fed. Okay? If they go up another 100 basis points, there is already 50 more basis points built into the forward expectations than have actually happened. So that means when things settle out, that you'd be expecting 50 to 100 basis points more than where you're sitting now on. So in some ways, those interest rates will overshoot for a little while, and then they'll settle back once they see what that stable forward is going to be. So if the Federal Reserve surprises up, I can't foresee any way they can surprise up other than being ludicrous and giving us 100 basis points in one shot. If they surprise up, then you'll see a big bump in those rates. If they don't surprise up, if they go up in a gradual way now, then you'll see those mortgage rates go up, but slower than the rate that the short-term interest rate is going. So it's why we're talking. That's why we're thinking about 6% at the end of the year. Is about what we're talking, which is about what my first mortgage was in 2002. So, and I was able to buy a house, and I wasn't rich. So, did I answer your question? Sure. Realize that a lot of purchases got pulled forward. You didn't need to be an economist to say that there was going to be interest rate increases this year. You didn't need to be an economist to say that prices were going up. So everybody ran out and tried to buy. If they were planning on buying this year, they tried really hard to buy this spring. Okay, so you probably had a really active spring because so many people were trying to do it, and so that helped force those interest rates up because so many people were trying to do it. But now that that demand has sort of slackened some, it takes less pressure on those interest rates. So I'm not sure I fully answered your question. It's a complicated question. So we have a class on it if you want to take 45 hours of instruction on it.
Hi, Dr. Isely. Thanks a lot for this. So a lot of your assumptions are based on, like CPI and how you said people's buying has been dropped, but not as much as it looks or whatever. In adjusted for inflation. But if you took actual like inflation, including food and energy and maybe stuff that's not maybe underrepresented in that, and we're really actually a lot lower than the assumption.
No, because I actually there was using what's called PCE.
Okay.
So PCE is different than the CPI. So CPI takes a basket of goods. So you can avoid inflation by buying outside the basket of goods. So if oranges are in the basket and apples aren't, you can choose your fruit differently. Okay? I used PCE. So what PCE does is look at everything that was purchased and then looks at the price of everything that was purchased. So it tends to have a lower inflation rate than the CPI, okay, because of that. But it also means I calculated everything that people purchased, not just bits and pieces when I did that. So it was not the core inflation that we used a little earlier in the presentation. It was inflation related to everything that was purchased.
Okay, so where I was going with that question was if for some reason one of those measures is not fully representative of people's buying behavior, or if we're actually going down harder than what it seems based on the math that you're looking at, you're obviously looking at it at a lot of granular level. Right. What would that change in the economy if it's really going down a lot faster than we think? And what would that change in real estate as far as short and long-term expectations, local and nationally?
Well, and we are going down faster than the data is, because the data is a month and a half old, and we know that we know anecdotally there's been serious slowing in the last 45 days. And that data will not show up in this official data for another month. So we know it's slowing faster than what the actual data says. So I had that built into my annual already. But if it slows down even more than that, then that will take pressure off the Federal Reserve from doing interest rates, and it will start to take pressure off of the prices. All right, so we'll be watching to see whether those price increases slow down faster than what I said. So right now I'm saying end of year, between 5.5% and 6.5%. Right now we're still running close to 7%. I'm expecting that the economy will slow down enough between now and the end of the year to shave 1.5 percentage points off of what's happening. If You'll know we're slowing down faster than that if you see the brakes hit on prices faster. What that does for real estate is it also means that we have a lower hit on interest rates. So interest rates will be able to back off faster if it slows down faster than what I said. And so right now the bond market is already betting on that and already betting that the Federal Reserve will actually have to slacken their interest rates next summer. And that's based on a gamble that it's going to slow down faster than what the Fed believes. Did I answer your question?
Yes, kind of. Yeah, there's just so many layers to it. So it sounds kind of like it's either going to go up slower than we, prices and stuff are going to, and the economy is going to slow down some and still go up, or it's going to correct sooner and then they'll be able to back off, and that will undo the pressure, the
Right.
downward pressure, and will
We firmly believe.
going up or flatten or.
Right. We firmly believe that you will feel like it's a traditional recession sometime in the next 12 months. And that it will start to affect employment at some time in the next 12 months. Because we're already starting to see some slack in the labor market in different places. We're already starting to see productivity go down, which means that we have more workers than we need. So we believe it will start feeling more like a traditional recession sometime in the next 12 months.
But probably different than 07, 08 because
Oh,
you don't
yeah,
have the supply.
07, 08 is not a traditional recession.
Very.
When I say recession, we need a new word for recession. In 1940s, economists had to come up with a new word because prior to the 1940s, recessions were called depressions. The Great Depression happened. They were scared to death to use the word depression because people envisioned the 1930s. So now when I say recession, most people's brains switch to 2007, 8, 9, 10. It shouldn't be switching to that. It should be switching to 92 or 2001, where you're not looking at something that's risking a large chunk of the population being underemployed. Okay? It's going to be much more sectoral than that. And because this one's going to be driven very heavily by interest rates, it has a big effect that it may happen on the real estate side of the house.
All right, we are past the 12 o'clock hour. So,
We are indeed.
do you have time for more questions?
I can do another question, sure.
All right, one more question here.
In that statement, you were just talking about comparing it to the 2008 recession where values around here went down 20 to 25%. What are you thinking if we have another recession now? Think housing prices will go down, what, 5, 10%?
I don't think that, I honestly think that the probability of us having flat here in Kent County is very high. I don't, and understand there's a difference. I didn't put the graph in here, but in 2007, 8, 9, we were running foreclosure rates that were off the charts. Okay. Right now, our foreclosure rate is a record low. Our 90 days late is a record low in Michigan and the United States. Why is that the case? Because they have $10 trillion extra dollars sitting around. All right? So people can pay their mortgage. If we don't have that big run up in foreclosures, we won't have that big erosion of price. We're going to see retrograde on prices in some markets, but markets that have lots of young people or have a draw that you all know the traditional draws that bring things up. They're likely not going to see much of a downturn, maybe flat. They certainly are going to see their appreciation slow.
All right, thank you everybody for attending today. Let's give Dr. Isely a great round of applause.